Okay, so I will be recording this session from this end, but I've also allowed the functionality for you to record from your device if you feel that you need to do the recording locally. I will also ask you to confirm if you are seeing the screen that I'm sharing with you.
Yeah, true.
Right. So right. So you can use your mic so that we don't get feedback from this end. So thank you for joining. So today we want to discuss two very key topics as far as your understanding of accounting is concerned. We'll start with introduction to company accounting, and then we'll move on to how we interpret basic financial statements of a company. So by now, you have already covered, or perhaps in the last semester, you covered accounting for sole traders, where perhaps we have Kamsika Kako and you want to account for the transactions that you do, or you've got your own tax shop or your own shop as a sole trader. You've also covered partnerships that I'm sure you are done by now, where you account for transactions where two people come together to start a business, perhaps for the benefits that you've already discussed. If you are coming together as two people, you can come up with more capital than one. You can bring in different skills, etc. So you've already covered accounting for partnerships as well. So today we are going to then take it a notch further to look at how you can incorporate a business as a private limited company. We are also going to consider a public company where you decide to list your company on a stock exchange for the benefits that we are going to discuss later. So now, before we discuss the accounting part of it, we want to basically discuss what a company is, or what incorporation is, and why we need to do that as opposed to operating a company as a sole trader or as a partnership. So the whole idea behind a company is, so if you are an individual operating a business as a sole trader, and you go and buy goods on credit from maybe your suppliers, and then you fail to pay your suppliers, they can then come to your business, take all the goods that you have so that they can recover the money that you owe them. They can also consider coming even to your house, take your property, because your business is you and you are your business. So they've got the right, or the legal right, to come to your business and come to your house and take whatever property you have. That would result in them perhaps recovering the money that you would have owed them. Right, so that's as far as an individual is concerned. You might also have discussed other partnerships. That if you are a partnership, you are jointly and severally liable. So let's say you are a partnership, you are in business, you owe money to a bank or to your suppliers, and then you fail to pay that money. The creditor or the bank can come to your business and take your assets in order to recover the money that you owe. In the event that the assets that you own as a business are not enough to cover the debt, the creditor can come to you individually as a partner to request that you pay whatever amount of money that you would owe them, which means individually as partners are liable for the debt of the. Right. So I want to ask you again to please mute your mic so that you don't get feedback from the noise in your background. Right. So we've said individuals and partners are liable for the debts of the business that they own, which means in the event that the business fails to pay, you are then going to be liable individually to pay the debts that the company would owe, or that the business rather would owe. Now, you can then decide to incorporate your business as a company. If you decide to incorporate your business as a company, it means the company itself becomes, or is considered, a person in law which means it can enter into contracts as a company without you as individuals becoming part of the contract. So it can have a contract with employees where you can maybe sign contracts of employment between the employees and the company. It can enter into contracts with the members or owners of the business where the company as a legal persona enters into contracts with shareholders. It can hire directors and enter into contracts with directors or any other third-party suppliers, bankers, etc., which means the company in itself becomes a legal persona considered to be the same at law as an individual or a person. So the advantage or the main purpose of registering a business as a company is there is then the separation between the owner of the business and the company itself, which means the transactions that you do as an individual do not affect the company. In the transactions that the company does not affect you as an individual. In the event that the company borrows money or enters into transactions and then fail to pay, it means the creditor can only go to the company and try to recover the money. If the money within the company is not enough, the creditor cannot then come to you individually as the owner of the business to ask you to pay the money from your own personal assets, because the company is considered a person at law which is independent from you. Right. So perhaps let's see, consider where the concept of limited liability comes from. So there was a case in 1897 of a sole trader whose name was Solomon. Solomon started his business and operated the business as an individual until such a time when he then decided that he wanted to register it as a company. So because he had already invested a lot of money in the business, didn't want then to just change the business into a company without any entitlement to him. So he decided to then say, all the money that I've invested in this business becomes the loan to the company that I am starting. So let's say, for argument's sake, he had spent 10,000 in the business, in buying stocks and doing everything that he has made the business what it was at that point in time. So he then created a loan where the company then needed to pay him back for all the work he had done when the business was still a sole trader. And then he used the asset of the business as security for the loan that he had given to the company. And so Solomon Private Limited now owed Solomon as an individual a certain amount of money secured by the asset of the business for the money that he had spent in starting and growing the business. A few years later, the business started facing challenges, and then it went into liquidation. So when it went into liquidation, there were creditors that were owed money by Solomon Private Limited, and himself as Solomon, as the starter of the business, was also owed money by the company. So when the company was liquidated, because he had secured the loan against the assets of the business, he then sold the asset of the business and started by paying himself first before paying all the other creditors. The creditors then went to court and said, Solomon cannot pay himself first from the process of the assets that he sold, considering that you can't separate Solomon from the business that he had started, but it only changed was that he had registered the company as a private limited company. So the case was considered in court, and then it was held by the judge who presided over the case that Solomon is a shareholder and the director had no personal liability to creditors, which means the creditors could not go to him and ask him to pay money that was owed by the company, because the company was a separate legal entity from Solomon. So the court then ruled in favor of Solomon and said Solomon can get his money just like any other creditor, because he was also owed by the company, regardless of the fact that he was the one who had started the company. So that's basically the concept of limited liability. So we are saying, if we are an owner of the business and we have invested a certain amount of money in the business, and the business liquidates or faces financial challenges, the liability or obligation that you have is limited to the amount that you already have invested. The people that are owed, or the companies that are owed by your institution or your company, cannot then come to you as an individual to request you to pay the debts that the company would have owed. So that then becomes the basic and most important advantage of you registering your business as a company. In the event that the business faces challenges, the companies or individuals or entities that you owe cannot come to you and request that you pay for the debts that the company would have taken because you are separate or different from the company that you would have owed. Right. So that's basically the concept of limited liability. Your liability is limited to what you would already have invested in the company. So let's look at the different types of companies that we have. So when you decide that you want to register your company or your business as a company, the first step that you take is to register it as a private company. So a private company is basically a company that is owned by at least one shareholder. The company can have 2 shareholders, 10 shareholders, 20 shareholders. It does not matter the number of shareholders that are there. But the major distinction between what a private company and a public company is the fact that the private company can only raise additional funds or share capital from the people that are already shareholders within the company. They can't go to the public and ask for funding in terms of shareholding. A public company means you have registered your company on a recognized stock exchange and you can issue shares to the public, and whoever buys the shares becomes part of the owners of the business. So what is normal is you register your company as a private company. Then after registering it as a private company, you operate for a few, maybe months or years until you build a profile for your company. After building a profile for your company, you can then decide to register that company on a recognized stock exchange. After registering on a stock exchange, it becomes a public. So public is in reference to the people that own the company. It's owned by public investors. Private means it's a few individuals that own the company, and you are limited to those individuals when you want to raise more capital. Now, you do realize that perhaps we might have come across companies called maybe Musayama Private Limited. So the private is in reference to ownership, is owned by a private group of individuals. Then the limited is in relation to limited liability that we have discussed. It means whatever transactions that are done by that particular company will be binding on that company as a legal persona, not on the owners of the business. So the private limited, private is private ownership, limited is limited liability. So that's basically the 2 types of companies that we have. So in terms of, so we have discussed the concept of limited. We've said the private company and private limited. So the limitation of liability, we've discussed that the liability is limited to what you would already have invested in the company. So most limited companies are limited by shares. So if you have invested 10,000 in buying shares in a particular company, it means if the company is to wind up, your liability is limited to the 10,000 that you have already invested. You are not going to be asked to pay any additional money in the event that debts that needs to be paid cannot be paid from the resources that the company already has. Then there's a second type of limited liability where liability is limited by guarantee. So what we are basically saying is you would not have actually invested any money in the business. What you would have done is you would have issued or offered a guarantee that in the event that the company faces any challenges and it requires to pay its creditors, I am guaranteeing that I will pay you 10,000. So you will only be asked to pay in the event that something that would have already agreed on has happened, for example, liquidation. So you have not actually invested any money. You are guaranteeing to pay a certain amount of money in the event that the company goes into liquidation. So the most common companies that you see written private limited companies are actually limited based on shareholding. Okay, so that's basically private limited company and a public limited company. All right, so perhaps the most important aspect as far as we are concerned from an accounting perspective is how we then account for transactions for a private limited company or for a public company. So the way that we treat capital is the same whether the company is a public company or is a private company. So let's consider what share capital is. So when you start a company, what you need to then decide is how much money am I going to invest in this particular business. So perhaps you are investing 100,000. So the 100,000 that you want to invest in the business becomes your initial capital. So on application for incorporation or to register your company, you are going to then say the amount of money that I'm going to invest in this particular company is going to be 100,000. Right, so that's the initial capital. Now, you don't want to then limit yourself to the amount of money that you have now. So you may decide that I wanted to invest a total of 500,000 in this particular company, but I do not want to give the 100,000 to the company all at once. So I'm going to put 500,000 perhaps over a period of 2 or 3 years. For now, I wanted to put just 100,000 into the company. So the initial capital is called authorized share capital. So let's say for argument's sake, our authorized share capital is 100,000. 500,000. So authorized share capital is 500,000. It means the amount of money that you are then authorized to invest in that particular company is 500,000. Of the 500,000, you want to invest $100,000 for now. So the 100,000 you wanted to invest for now becomes the issued share capital. So of the 500,000 authorized share capital, I am issuing shares worth 100,000. That's the issued share capital. Then perhaps the 100,000 that you wanted to invest now, you want to invest 80,000 now, and then a further 20,000 in 3 weeks' time. So the 80,000 that you would have paid now on incorporation of the company is called up capital. So the called up capital is the portion of the issued capital that you have actually paid to the company. So the 20,000 that you would pay in 3 weeks' time becomes the uncalled up capital, the amount of money that you are going to pay, but that you haven't paid yet. So authorized share capital is the total amount you're authorized to invest in the business. The issued share capital is the total amount you have actually promised to pay to the company. Now, the called up capital is that portion that you would want to pay today. So in most cases, the issued capital and the called up capital would be the same. So you then realize that when you are preparing your financial statements, what you see written share capital is actually the issued share capital. All right, so I hope that is clear. All right, so let's consider what share capital really is. So I apologize that we have a limitation in terms of time. We delayed in terms of starting. So we have 4 minutes left for this particular video or for this particular session, which means you need to rejoin again for another 40 minutes so that we can then take it from the definition of share capital and then the accounting that we do in terms of the shares when we issue them. So this session is then going to end, and then you are going to then use the same link to rejoin again. All right, so let me use the time that is left to explain what a share is. So let's say, using our example, you want to invest $100,000 in the company, but you want to issue certificates to the people that are going to putting the money in the business. So if it were 2 people, one giving 50,000, the other giving 50,000, it means you are 2 people investing in the company, each investing 50,000. So you could decide to create just 2 share certificates. one for 50,000, another one for 50,000, which means the company will then have 2 shares of 50,000 each. Or you could be 5 people, each investing 20,000. You can decide to then issue 5 share certificates of 20,000 each, so that each share certificate represents a share. So the number of shares that you issue will then determine what we call the par value. So the par value is basically the amount being invested in the business divided by the number of shares. So if you want to issue shares of $1 each and you want to raise 100,000, it means you're going to issue 100,000 of 100,000 shares of $1 each. So the par value in itself is a meaningless figure because it's not representative of a cost. It's basically a value that we give for us to be able to split the shares into the number that we want. So we could be raising the same 100,000 and issue 10 shares or 20 shares or 100 shares, but it then determines what we call the par value of the share. So a share represents the interest in the company or perhaps the money that you have actually invested in the company. So if you have 50,000 shares of $1 each, it basically just means that you would have invested 50,000 in that particular business. So the shares that you would have bought will then give you the right to make decisions within the business. So decisions within the business are made by shareholders through voting. So it then means whoever has got the most number of shares is the one who is going to make the decision. So for example, if there are 100,000 shares and you wanted to make a decision, would expect that 50,000 plus 1 shares are the ones that are going to make the decision. So for example, if you are voting on whether to buy a certain asset or not, and a person with 60,000 shares says yes, and the person with 40,000 shares says no, it means the person with 60,000 shares is the one who wins because he's the one and a majority of the shares. So the shares themselves will then determine your voting rights or will give you voting rights, and the voting will determine the decisions that are going to be made within the business. Then every holder of my shares in a company has the right to receive dividends. So dividends are basically shares of profits. If business makes a profit and you want to share those profits, you are sharing based on the number of shares that you would actually have. So the more shares you have, the more you get in terms of the profits that the business makes. So when we restart this session, we are going to then take it from the explanation of dividends then going forward. So you can please rejoin using the same link that you used to join this meeting. So see you soon.